Alrighty, guys, we're going to go ahead and get started. Thanks for joining us tonight. My name is Tyler Arbaugh. I'll be hosting this workshop. This is my first year here at the Financial Wellness Center, and I'm also a peer financial coach, and I'll kind of go into what that entails later on in the presentation. So our mission at the Financial Wellness Center is to empower students with the knowledge needed to make sound financial decisions during and after college. Investing is a huge part of finance, and knowing how to make smart choices and control your investments in a positive way is really going to impact your life in a great way. The big 5 things that we talk about at the Financial Wellness Center are budgeting your money, managing how you spend your money, borrowing money. Some of us are on student loans, some of us have credit cards, and some of us may be curious about building credit. So that's the big thing we want to talk about. Protecting your identity. Identity theft is actually one of the biggest crimes in the United States right now. So we do have a couple workshops that talk about how to protect yourself and know how your identity got stolen if you do get your identity stolen. And then what we're talking about tonight is saving strategies and investing, mostly just investing, but we do host workshops about how to save money smartly. So like I said, I'm a peer financial coach, so I will go to meetings with students. It'll be one-on-one, totally personal. We can discuss whatever you want. Feel free to email me or sign up for a one-on-one meeting if you have any questions after this and you want to get more information about investing or anything we cover in this. I'll be happy to help you, and so will any other of the PFCs. We can talk about credit building, budgeting, repaying credit if you have debt. We also build partnerships across campus with Greek Life, student athletes, and different schools within the university. All right, so first things first, I just want to make sure everybody knows these resources because they're super helpful, and you'll see me use these throughout the presentation. Investopedia, it's a great website for just explaining everything investing. If you have a question about what's going on in the market right now, they have like blog posts and different stuff like that. And also terms, it's a great resource to use if you have any questions, because it's really important you understand what you're getting into. You don't want to go in blind with your money because you worked hard for your money and you should know what you're doing with that money. Yahoo Finance, super popular, just lets you view the performance and details of different companies. And then I'll go into that a little bit later. And lastly, at the Financial Wellness Center, we always recommend that if you want to start investing or have questions about money, talk to people you trust first. And if they have an advisor, maybe reach out to them and ask them questions. So that's a great place to start. Is you're really close to your family, really close to your friends. So why don't you talk to them? And then if you have questions after that, reach out beyond that scope. All right, so getting right into it, what is the stock market? The stock market is a place where a buyer and seller agree on a price to trade said stock. Now, it's not really agreeing, but if you buy the stock, you are agreeing to that price. You can't come in and be like, okay, I want to buy this stock for $10, but it's currently at $14. You have to buy it at $14. And this, I think, is a good illustration. So you can see a lot of people, this graph on the right here is showing the different orders. So you can see there's 10, 12, 14, and 16. So if you go up from that, those are the volume of orders that people want to place. But right here in the middle, that's where the stock price is, where the green meets the red. That is the current price of the stock. And these are just showing the orders. And this is why the people have to agree on that, because this is the price they're going to pay. Their order is only going to go through if it either goes up in price or down in price wherever they place their order at. So it's really important to understand that when I say agree, you are either going to wait until the stock hits the price that you want to buy it at, or you're just going to pay market price, which is pretty much you buy whatever the stock is currently at. So how it works, a buyer is going to place an order to purchase a stock, and a seller places an order to sell a stock. Like that picture comes up again, but if you look, green is on the right because buyers will increase the stock price, and red is on the left because sellers will decrease the stock price. And together they meet in the middle to determine the stock price. Along with other factors, there's a ton of other stuff that goes into it, but that's really just the basics of how a stock price gets determined. Let's jump right off into an example, right? So Aaron finds he has an extra $300. You know, he's cleaning out his couch, looking through his car. You know, he just finds a wad of $300. So he places an order for 2 shares of Apple, and Aaron's now a shareholder of Apple, right? So he just used that extra money he had, and he said, well, I don't need anything else right now. I'm going to invest it. So that's what he did, and he bought 2 shares of Apple because they're about 150 bucks a piece. But let's look at a selling example. Amy decides she needs to sell some of her Apple shares to cover her car payment, and sometimes those decisions have to be made, but you never really want them to happen. That's kind of what we're going to talk about today, going into learning the fundamentals of strong investment strategies. So breaking down this example, investment should be made with money you have after paying all expenses and other debt, where Aaron used money he found and it was kind of extra money for him because maybe he already paid his rent, got his groceries, so he just didn't have anything else that he needed to use that money for. Whereas Amy, she forgot to pay her car payment, so she had to withdraw money from her investment account to make said car payment. It's really important that your investment stays in the market, or you just keep your money invested as long as possible, because then you get the compound interest of investments. All right, so kind of what I was talking about earlier, why the stock prices change. It's dependent on the behavior of traders. They have a strong pull in it, as well as the company's performance. Does anybody want to like come up with a company name that's like really popular or something like that? Just type it in the chat, or you can turn your mic off or unmute yourself, I guess. Tesla, okay. Let's say Tesla, the company's super profitable. If you look up Tesla, you're going to see it's a straight line up pretty much for the most part. And performance are really strong performers in the stock market. And the behavior of traders, right? So people always think, oh, Tesla, it's not going to go down. And when it goes down, people just buy more because they automatically know it's going to go up. That is just the history of what has happened with Tesla. But let's say Tesla comes out with a new car. I think this definitely happened when they announced the Cybertruck. People thought it was the ugliest thing in the world, and I'm pretty sure you saw a drastic change in their stock price because the behavior of the traders, people who invest in Tesla, will maybe buy a Tesla car, and if they're not happy with the way the company's going, they're going to sell their stock, and that's going to have a drastic effect on the company, and it's going to drive their stock price down. But on the other hand, maybe Tesla announces a new electric car and it starts out at $20,000, right? That's going to be huge for them, and they're going to take over much more of the market share for electric vehicles, and their stock price could go up because traders are super happy of where the company's going and how much more affordable the cars are getting. So it's really important to look at the performance of the company and understand kind of what's going on around the company's name. All right, so asking yourself if you're ready to invest. The really big thing is kind of with the examples is, can you afford to put money away right now? We want our investment to stay in the portfolio that we've created as long as possible. And to do that, you have to basically say, okay, I'm setting this money aside and I'm not going to touch it. I think Warren Buffett says, don't invest if you can't afford to live without that money for 10 years. And 10 years, that's a long time, especially for us people that are younger. We're in college right now. We're going to have debt to pay off. We don't have a full-time job. Some of us do, but most of us don't. It's really important to understand that you can start investing now, but you won't be able to invest as much money as you would be able to if you had a full-time job. So it's important to understand that if you can only invest 50 bucks a month, you can only invest 50 bucks a month, and that's your situation. Every situation is going to be different for everybody, and everybody at the Financial Wellness Center would be more than happy to talk to you about that and kind of thinking about different strategies, how to budget your money so that way you can invest more possibly. That's a big thing that we help out with. And speaking of budgeting, we host tons of workshops about this. It's one of the key components to the Financial Wellness Center. It allows you to control where your money goes, right? So it's super important to understand that if you can spend less money in one area, you'll have more money to invest, right? For this situation. But if you need to pay off credit card debt, right, you're going to need to spend less money in some areas to be able to really drive that debt down so that way you're debt free in the future. Budgeting is also really, really helpful to allow you to consistently invest, and we'll get into why that's important later. But having a monthly budget and saying, okay, I'm going to set aside $75 every month to invest, that is going to do huge things for you in the future if you can consistently invest every month or every week or every 2 months. Whatever you can do to get on a schedule, it's super helpful. And of course, budgeting, if you stick to it, it'll make your dreams come true. Your financial dreams, that is. So, all right, so we're ready to start investing. First things first, we got to sign up for a brokerage account. Really important here that you understand what the company is getting from you. The company is going to get paid some way or another, whether that's from people with a little bit more money paying them to manage their money, or whether it's commissions for every trade. So it's really important to understand why or how, I would say, the company is allowing you to trade freely if they do. It's important to understand either what they do with your data about your trades or where they're getting their money from, because they're billion-dollar companies and they're getting paid. It's very important that you understand how, and you need to make sure that you're comfortable with it. Does anybody have any questions about that?
What is your recommendation in terms of like what to go through when beginning an account like at our age or
Yeah, so I don't have any certifications, so I can't give you my personal recommendation. I would go to your parents or someone you trust and see where they invest and see if you can invest there and see if you're comfortable investing there. These are all really big ones. If you notice, I didn't put Robinhood on here and Webull. Those are super popular too. I just didn't put Robinhood on here because of their, I don't know, just the history of them. If you don't know about that, do some research on that. It's kind of interesting, but I just didn't put Robinhood on here. Any way that you can start getting investing, and if you're comfortable with how a company treats you, your data, and your money, then I would say go for it. Do whatever you want to do and whatever you're comfortable with. But these are the really big, I would say. Fidelity and TD Ameritrade are the big ones. All right, so fees and commission. If you can only afford to invest $50 a month, right? Maybe you don't have enough money to pay for commission every month. So it's important to understand that if you're on a budget, how can I invest my money the best way so I can get the best return? And if it's a $5 commission for every trade, that's like astronomical, but that means I can only invest 45 bucks a month and I'm not going to be able to invest a month. What type of accounts they let you open? That's a really good one too. If they only let you open up IRA and Roth accounts, maybe you don't want to do that right now. So you just want like a regular basic account. Their system efficiency, that's a really good one too. You want to make sure they're efficient and they're getting your trades in at market price or whatever you set them through in. So you want to have fast trade time so you get the price you want. And accessibility, right? Everybody's banking on their phone, on the internet. It's really important to have access quickly to your funds if something should go wrong. And then my boss Gilbert put a link in there to a broker check. If I'm not mistaken, it kind of gives you details on every single brokerage or very popular ones that you could be interested in. So that's a very good resource to use. All right, so moving on. So you selected your brokerage and you're ready to start investing. And first things first, you have to build your portfolio, right? And if you guys don't know, a portfolio is the collection of all your investments, like stocks, bonds, and cash. But we're mostly going to be talking about stocks today. Bonds and cash are included in your portfolio. And like I mentioned, I used Investopedia for this definition. And usually stocks and bonds are considered the building blocks of a portfolio. So that means the base of your portfolio is going to be built on them. And notice how I didn't say crypto. It's just stocks and bonds. That is a proven history. Crypto is still kind of new. I personally only invest in stocks, but it's your money. You guys do whatever you want to do. And also, diversification is a key concept of portfolio management. And guess what? We're going to talk about some diversification. All right. So, key steps to building a really strong portfolio is diversification, research, consistency, and dividends. And if you follow those and keep those in mind at all times, right, you're going to pretty much be exactly what this picture shows. You're going to go from 1 to 4 to 8 to 16. You're just going to keep growing over time if you have a very diverse portfolio, you're very consistent. These are the big things to a very strong investment plan. All right, so going right into diversification, you can build your portfolio in like hundreds of different ways, right? Make your portfolio yours. So these are the kind of the different sectors, right? So we have energy, materials, industrials, utilities, healthcare, financials, consumer discretionary, consumer staples, information technology. So those would be your big technology companies. And make your portfolio yours. Invest in things you actually use. If you only buy Nike stuff, invest in Nike, right? And if you only buy Apple products, invest in Apple products because you're a user of their products, right? When you purchase that, you are saying, okay, I trust you enough to either put your shoes on my feet or use my computer every day. So you're helping that business by purchasing their products. You're directly impacting their stock price, whether it be very minute, like 1,000th, 1 millionth of a cent, right? But you're still impacting that company. So if you if you invest in things you actually use, it should turn out pretty well for you. And next, we're going to talk about different ways to do research. It's important that you have some sort of idea you want to invest in, and that really just plays a role in making your portfolio yours, right? So if you want to invest in clothes because you love clothes, invest in clothing companies, right? If you love technology, invest in technology companies. Or maybe you're a big proponent of solar energy. I know there's tons of solar energy companies out there, and you can invest in all of those. Make your portfolio yours. But I would say on top of that, follow what the professionals do. It's very hard for people to pick the next stock. People do it, but it's very hard and very rare. So if you work for your money, and this is the only money you can ever invest, you're going to want to use trusted investments that you can grow your investment upon. If you do want to do your own research, I highly recommend Yahoo Finance and using their screener function. That will allow you to basically filter to what you want to go to. I know this picture is kind of blurry, but you can select the industry, the market cap of that, and that's pretty much how much the company is worth. So we're looking at like a mid-range value company, and I'm looking at technology and services. Going in even further into that, I'm filtering it to only business services, information. So I just got a question in the chat. So how do you find professionals to follow? Like you can look into Warren Buffett, like historical people, and I would say if you're looking into a brokerage and they have like a blog or something written by somebody in the investment industry, I think that could be a good choice to follow them. And professional, like make sure they're a professional, right? It's not somebody on Reddit saying, "Oh my gosh, like it's going to the moon tomorrow." Like they could know that and it could go to the moon, but are you willing to put your money into that, right? But if you follow a professional, say somebody who works at Merrill Lynch, and they say we see a usual 7% increase every month for the past 18 months, and we highly recommend this to all our users. Then you could really sit there and consider 7% every month. That's pretty good. Like I could see myself investing and growing into that. So it's important to understand like actual professionals in the industry and kind of the internet professionals. And she also asked about a trusted role model. Warren Buffett, he's up there. He's one of the best value investors, I would say. His big thing is to make your portfolio yours and invest in things you actually use. I've done that and I've had good success with that. I know a lot of people like the CEO of a investment company. I feel like it's called ARK or something like that, but she's had a really good track record of finding companies that are like very undervalued and they spend hundreds and thousands of hours a year finding these companies, and that is kind of what they've really kind of built their history on, is finding those undervalued companies. But yeah, moving on. If you're going to do your own research, yeah, and Kramer as well. Like if you watch any of those CNBC, Fox Business, those are all people in the industry and they really know what they're talking about. So don't be afraid to just watch those on the news one day. I know at my summer internship, they had that playing on the TV at all times, and I like never watched the news before, but I started watching that, like just glancing at it whenever I had a chance, and like I just watch it all the time now because it's super interesting. to watch that for me. So don't be afraid to watch the business channels. And then going on to consistency, regularly purchasing the same securities, whether that be a stock or a bond, is super important. And find securities that you can afford to regularly purchase and achieve dollar cost averaging. So let's say your investment budget is, do I recommend Bloomberg? I can't recommend anything, but I would say do your own research, find out what other people in the industry have to say about them, and then kind of decide for yourself. Consistency. So if you have $75 to invest every month, find something that maybe is around the $30 mark. If you have something around the $30 mark, you can purchase 2 shares roughly every month. And so if you can do that, that would be great because you're buying 2 shares every month. That's 24 shares a year. And if it's $30, I'll do the math. That's $720 invested throughout the year. So that is huge. And plus the company, and this kind of gets into dollar cost averaging before I start what I was about to say. And plus the company will go up and down throughout the year. So if you can consistently invest and purchase 2 shares every month, that will be huge because the stock price may go down to where you can afford 2.25, 2.5 shares. So you're buying more shares that month. And then sometimes the company is going to go up in value and you can only afford 1.5 shares, right? But since you bought it every single month, the months when they were down, you bought more. So when the stock price goes up, you have more shares in your portfolio already. And that's kind of the gist of dollar cost averaging. That's a very broad definition of it. But if that interests you, schedule a meeting with the Financial Wellness Center and we can really go into that and help you make a budget so that way you can achieve dollar cost averaging. And regularly purchasing the same securities, you can really only dollar cost average if you purchase the same stock every month. And say you start your investment account with $300, and from that point on, you can only invest $75 every month. So maybe with that $300, you can afford a $200 stock, but after that, every month you won't be able to. So it's very important that you understand when you start your portfolio, do you start it with a lump sum or do you start monthly? And it's up to you, whichever you want to do. But just keep that in mind if you're trying to achieve dollar cost averaging. And dividends and passive income, right? So, and from Investopedia again, a dividend is a distribution of corporate profits eligible to shareholders. So corporate profits, if the company does well, the companies have to give back money. They don't have to, but they decide to give back money to the shareholders. And so what that looks like, I snagged this off the internet this morning from Coca-Cola. They're known as one of the best dividend providing companies. I think they pay consistent dividends for over 50 years monthly. Right now, they're giving you a 2.77 annual dividend yield. So what that means is 2.77% of $60 right now, and they're going to split that up into quarters. So every 3 months, you will receive 42 cents. It doesn't seem like a lot, but that's for one share, right? So if you achieve dollar cost averaging on this, right, you could have, maybe 10 shares by the end of the month or by the end of the year through one year of investing, right? And so those dividends are huge. And the good thing about dividends is they'll usually allow you to reinvest them back into the company. So you buy more shares with your dividends. Now it's going to be pretty small since you're looking at that, 42 cents every quarter. That's really, it's not even a dollar of the stock. So it's not even a 60th. So it's not going to be a huge increase in your portfolio, but it's a good starting point. And that's only for one share, right? Maybe you have 20, 30 shares. Now you're buying a quarter, a quarter of a stock. And that's huge, right? Or with passive income, if you have enough dividends, you can just cash those out and they'll write you a check or put it in your investment account. And some people do live off that. Now they have massive portfolios, but it can be done if you start investing early enough in high paying dividend companies. All right. So going into other ways to invest instead of buying just like one company like Nike, Apple, Tesla, you can purchase what's known as an ETF or a mutual fund. So an ETF, they're going to track different markets, and we'll go into that a little bit. And they're also going to track sectors, which is kind of what we talked about earlier with the diversification. If you remember that picture, there's like 12 to 16, I'm not entirely sure, but different sectors, right? So if you want to track the clothing industry, technology, that's a super popular one, like clean energy, drinks, whatever you want to do, right? There's something out there for that. And they also track currency. So if you want to track the European dollar against the American dollar, you can do that. And a mutual fund, those are going to be a basket of companies. So what that means is instead of you investing in just Apple, you can invest in the 30 best performing companies for a year. And what that'll do is if Apple tanks to the ground, you could lose all your money if you're only invested in Apple. But if you do with a mutual fund or an ETF, you'll have multiple companies, and that will allow you to kind of lessen the blow that would hit your portfolio if a company tanks. And also, you're not going to see a 30% gain in one day, but you may see a 25, 20% gain in a year. I mean, I'm just making these numbers up, but it can be done. It's a lot more consistent growth and stable, and you're getting a wide range. You're kind of casting like a really wide net into the stock market, and you're kind of capturing very small returns, either positive or negative returns. So just a little bit more about them. ETFs have like kind of share-based trades. So if you want to buy an ETF with $60, and if you dollar cost average that, that's great. You can buy it every single month, or maybe you only buy it once, right? But it's going to be a consistent price, and you're just going to buy it at market value. Mutual fund, however, you're going to have a minimum investment, and usually the cheapest one you can get is around $250. So you're going to have to put in $250 first, and then you can keep investing on top of that. But you're going to have that minimum to start investing with them. And after you reach that minimum, you can keep investing maybe 10, 15, 20, $30, however you want to, depending on the mutual fund. Important note about these, both of them have fees like 90% of the time. What that means is it'll be like 0.2%. They're going to charge you a fee. Whatever you make in that year, they're going to take 0.2% of that. It could be higher, it could be lower, there could be no fees. And in that case, that's great. But does anybody have any questions about ETFs or mutual funds? Those words are really thrown around a lot. All right, so what I said about ETFs and how they track different markets. So there are different markets, right? You always hear, oh, the NASDAQ's up, the S&P's down, and the Dow Jones, right? So what those are, they're all in the stock market as a whole. And then you have all your companies, and then you also have these little markets called the NASDAQ, the S&P, and the Dow Jones. These are the really popular ones. There are some more out there. But here's what you need to know. The NASDAQ is composed of 3,000 technology companies, and the NASDAQ's a lot newer than these older ones. Technology, like your Apple, Microsoft, Google, and Meta, formerly known as Facebook. And now the S&P 500 is the largest 505 companies listed on the market, weighted by market cap. So market cap, I kind of talked about this a little bit earlier, but that's going to be the value of the company. Like, I think Tesla was the first one to go over 1 trillion. Don't quote me on that, but I think that was them. But that's how much the company is worth, right? So that's where you see like, oh, Nike's worth 100 million or something like that, probably more. But that is what market cap means. And the important thing is a lot of the largest companies are technology companies. You're going to see some of the NASDAQ spill over into the S&P 500. That's just because the technology sector right now is leading the market and controlling it. And lastly, the Dow Jones. These are going to be the top 30 blue collar companies. Those are like your manual labor jobs, like Sherman-Williams. If they're in the top 30, their stock price is going to be averaged in along with all the other manual labor jobs. And that is where you get your Dow Jones. And so when you hear like, oh, the S&P 500's down, the Dow Jones may be down a little bit. It could be down more. It could be up even, right? So they're all separate, but they all do have a little bit of a connection because some of them will spill over into each other just based on how the market is calculated. And here's a good illustration I like. So I'm not sure if you can see the dates down at the bottom, but it starts out in 2010 and goes until 2019, 2020. So blue is the NASDAQ, and you can see the NASDAQ has outperformed vastly, and it's about 325% gain since 2010. So that means if you invested in the NASDAQ in 2010 and you put $100 in, right now you'd be at like $325. That's only if you put $100 in. Maybe you put $100 in once a month. That's $1,200, right, throughout the year. And if you're constantly doing that, look at this stable growth, right? I mean, the Dow Jones was up 137%, not as much as the NASDAQ, but it was still positive, right? And so you can see these big dips right here, how they all had those in common. That's how you can usually tell something happened. The market was in a downturn, maybe a virus broke out, like over here. So they're all going to be connected a little bit, but some will make bigger leaps than others. That's just the difference in those markets. But I mean, if you can find something that tracks the NASDAQ, and I know the one I invest in is about $60, and so that tracks the NASDAQ, and so maybe I'm only getting 4% a month, but I'll take my 4% a month because it's tracking the market, and I can trust that the NASDAQ will go up, or at least I believe in it at will, and other people do as well. But yeah, does anybody have any questions about the different markets or any other question from earlier? Are mutual funds and index funds the same? There's a little bit of a difference. I can't really tell you off the top of my head. I'm sure Investopedia could tell you, or yeah, I'm sorry, I can't personally answer that question, but if you look it up, I'm sure you can find a pretty solid answer. All right, so the key takeaways for this are going to be budgeting. And if you have any questions about that, reach out to the Financial Wellness Center, connect with a peer financial coach, or come to a workshop like this where they'll go over budgeting, how to start, how to follow it, and how to adjust it to make it yours. Stay invested. We want to put our money in and we want to leave it there because you want to have this right here. You want to have this, right? You don't want to invest here and then take it out and like or I guess you don't want to invest here, take it out, and then you lost all this right here. This is huge, right? We all want that in our portfolio. So if you leave your money invested as long as possible, you're going to see greater returns in the long run. Follow the professionals again, right? Watch the news, do your research. If there's a trusted blog. Oh, yeah. So the Financial Wellness Center, sorry, I just got a question in the chat. So the Financial Wellness Center is on campus. I don't believe we're doing in-person meetings right now, but we will do them on Zoom. We help students out with basically their finances, right? We have 5 main areas: budgeting, credit building, investing, saving, and identity, protecting your identity. And we will be more than happy to help you with anything related to finance that's outside of that. And if we can direct you somewhere, we will definitely help you do that. But I see Gilbert put the link in the chat for that. So if you have any questions or you're more curious about that, definitely go check that out. And then if you'd like to schedule an appointment based on anything you heard here, or if you're more curious, schedule an appointment with us and we'll be more than happy to help. So like I was saying, follow the professionals, right? They're in the industry, and to have their job, they have to be making the right decisions usually, but follow them and you'll see a good return from that, and know what options you have, right? So understand that if you only have $60 to invest every month, you're going to be able to find stuff that costs $60 or less than that, right? You don't have to spend all 60 on one thing. You could spend 2 things that are 15 and 1 thing that's 30, right? So understand the options. There's so many things to invest in. You have a ton of options of building your portfolio and making it yours. And that's another key takeaway is making your portfolio yours. Invest in things that professionals invest in, but also do your own research, right? A professor here at the University of Oregon says only use about 10% of what you can invest into companies that you choose, because if finance isn't your game, you might not do all the research you need to. You could be misled on an article. So you want to minimize the loss, if there is any, from a company that you could have found on the internet. So it's important to really only use a small part of your total portfolio in investments that you find. That's why it's important to follow the professionals again. But I believe, is there any questions? All right. Feedback, if you're a UO student and you have a UO email, please send us your feedback. And if you do, you'll be entered to win a financial wellness swag box. I don't want to spoil what's in there, but it's pretty cool stuff. Make sure you guys go do that. This is the QR code to provide your feedback. It'll take you to the website and you just fill it out. Follow us on Instagram at the Financial Wellness Center. We're on Twitter as well, and Facebook and YouTube. And thank you for coming to the workshop today, guys. I hope you learned something from it.